Hello, and welcome to this special edition of The Alternative Exit, live from the Employee Ownership Conference in Telford in the UK. And this has been brought to you by EOT Expert by Christian Wilson. So just imagine you've sold your business to an EOT and are now happily retired, spending your tax incentivized money when HMRC or the tax man knocks on your door to ask for the full repayment of your capital gains tax due on the sale. A trust which is a huge pain. I mean, a trustee at your old company has just resigned and the team innocently but improperly accepted the resignation, inadvertently triggered a disqualifying event. This is a nightmare scenario. The truth is, running an EOT is not simple. From appointing trustees to managing the trust registers to keeping on top of all the annual one-off filings. One small mistake can be painfully expensive. This is where EOT Expert by Christian Wilson step in. His EOT assured service keeps you compliant and confident with clear guidelines, templates, and tailored support, whether you need a one-off transaction, support, or ongoing retainer. Christian can even help you set up compliant bonus structures to ensure that your staff are getting the rewards that they deserve. So if you're looking to make a transition to an EOT or already established an employee ownership trust that wants peace of mind and proper governance, reach out to Christian at eotexpert.co.uk for technical expertise that's reassuringly human. Hello, everyone. Welcome back to The Alternative Exit. It is lunchtime here at the EOA conference in Telford, and very excited to be joined by Chris Walton from Shawbrook. Very excited about this conversation. I think a lot of the times when people think about the amazing growth that's been in the sector of EO here in the UK, a lot of it's been driven off the back of this amazing incentive, like tax-free incentive that people have been able to get to with 100% discount on their capital gains. It's awesome. It's huge, but it still creates a huge barrier for people, right? And there's because people they're deferring the payments to be able to get that over time. Yeah. And a lot of the times because there's been a lack of finance to be able to do that. Then I heard a little bit more about what you guys are doing at Shawbrook, which is very exciting. So could you tell us a little bit more about that?
Yeah, of course. So here at Shorebrook, we are a specialist SME lender. And my team, we look after owner-managed and employee-owned businesses. So this, the whole EO ecosystem is very much what we do. And we've been a specialist in the EO space for many years. It's an area that we think is really exciting. But you're right, it's an area that historically has been a bit underserved from a finance perspective, and that often has been a barrier to employee ownership transition.
Yeah, I mean, it's a huge barrier. I mean, if you think about you look at employee ownership over in the US, obviously it's a lot more mature in terms of time, but also there's the service provider industry here is quite strong but they've had growing alongside that strong service providers is a strong finance industry. Why do you think that not many other providers like you have cottoned on to the power of employee ownership?
I mean, it's an excellent question. I think some of it comes down to, part of the reason Shawbrook as a bank exists, which is a lot of the more traditional mainstream lenders have retreated to areas that they find safer or simpler, and anything that is out of the ordinary, they left it alone. And we were founded to try and fulfill what we felt were those underserved niches, and employee ownership is a great example of that. It's we think there are really great businesses that are employee owned. There are really great lending opportunities for us, financing opportunities, and it is slightly baffling that it's been so underserved because there's nothing fundamentally from a lending perspective different lending to an employee-owned business as it would be anything else. There's challenges, there's things to think about, but there's no reason that you can't access finance and lenders can't play to that. But what you do need to do is you need to understand some of the nuances that employee ownerships and employee-owned businesses have.
Okay.
And I think that's where a specialist can come in, because we have dedicated teams that are dealing with EO businesses on a regular basis, and that allows us to have the confidence to provide finance in those situations.
Yep. What are some of those nuances?
So I think, as a banker, the lending money to businesses is what I've been doing my entire career. I think the fundamentals of what is a good business and what makes a good business to lend don't necessarily different for any business, but there are nuances particularly around governance and the people and the management of the businesses, and how a business going through transition needs to prepare to bring the employee owners on the journey with them, and how you think about setting up both the executive management and the governance of the business through employee ownership. And that's a piece that we spend a lot of time focusing on when we're funding businesses going through that transition, is how they prepared for that, how they thought about how the business will change when it goes to be employee owned.
Well, that's a very different element of due diligence that you guys need to do on these companies.
Yeah.
I mean, a lot of the times you're probably, I don't know, I'm putting words in your mouth here, but I don't know, in your prior to sort of focusing on this, it's very much focusing on the business metrics and sort of what's on the management deck.
Yeah.
Whereas now you need to go beyond that to understand more about the culture. Is that right?
Yeah. I mean, the numbers are still important, clearly.
Yeah.
But yes, and management is always important in any business. But there are, I say, particular challenges that come with how you manage business that is employee owned, and how there's real strengths that come from that. And when you get it right, as I say, as we talk about a lot, over the last few days, the superpower of employee ownership and the benefits of engagement you get with that. But it's not easy. We've got to work on it. And therefore, you're right, it is a different level of diligence around not just through the management team, what are their CVs, yada, yada, yada. It's more about, how have they thought about what employee ownership means.
Okay.
The tax advantage is clearly, very compelling. But if that's the only reason someone's going through the transition, then they're probably not going to be well prepared for it. And that means it's going to be more challenging for us to provide finance to it.
Okay. Hey, how do you train your team to be aware of the nuances of this employee ownership, to understand, hey, this is a good implementation plan, this one's a bad one?
Yeah. So, I mean, a lot of that comes down to experience. It's about hiring, good people that have experience of working with management teams.
Yeah.
And for particularly, younger, junior members of the team bringing through, it's about getting them exposed to, events like this.
Yeah.
One of the joys of my job is I spend a lot of my time talking to business owners, talking to employee-owned businesses, talking to the managers, both that are going through the transition or existing clients that already have that we continue to support, through their lending. And therefore, a lot of that learning is about, is making sure we engage with the community and conferences and events like this. But fundamentally, it comes down to working with the businesses, talking to the management teams, and going on that journey with them.
Yeah. Okay. Really, really cool. And so, what are the things that you see these great businesses when they're sort of coming to look for some debt as part of a transition? What does good look like?
So it's a great question. But what does good look like? It's about having a clear idea about why they're making the transition.
Yeah.
What they want the business to look like post-transition in terms of the governance, management of it, and what's the strategy for the business. Particularly, we deal with owner-managed businesses, founder-run businesses, and therefore you've got often very powerful personality, strong views about how business is run. That's great, and that's part of the non-owner-managed business and the founder-owned business that we support. Those founders are great individuals, but when they're coming to end their careers, to retirement, they're thinking about how do they hand over the reins. Having a clear strategy for how the business will be driven forward under this new guy is the key piece that we look for.
Okay. We talked about what good looks like. What are some red flags?
So I think some of the red flags are, we talked a little bit about already, if it's, if the interest is really only about the tax advantage and not about the business. If they've perhaps...
Well, and just press on that a little bit. I mean, the reason why you're saying that is, I'm presuming from a risk perspective, that puts you're seeing that actually puts your repayments at risk, like increases the exposure because the business isn't going to be run well. Is that
absolutely? So it's all about, for us, we want to make sure we get repaid. And therefore it's about how is the business going to succeed post transition. And if that plan isn't thought through and it's just we want to quick exit and run for the hills, then we want to be with the business on the long haul all the way through. And therefore the red flags are that the plan is underdeveloped. And there's founders who want to exit quickly and there's founders who want to exit gradually. There's nothing wrong with either of those things. It's all about have they thought through the implications of that and do they have the team around them to facilitate whatever that exit horizon is. And also the humility to recognize that plans might need to change. We know many founders who think they want to stay involved and actually realize sort of 1 foot in, 1 foot out is really difficult or it doesn't work for them. And they need to give space to the employee owners and to the new management team to thrive. Others may want a full exit, but realize actually that's quite hard to achieve day one. And actually they need to do a more gradual transition to hand over key relationships or to bring on, some of the MDs of the future into the business. And actually that sort of mentoring and development role is something they can find as a sort of new lease of life. But having been a owner, manager, controller of the business, that transition can be really compelling for them, really fulfilling. It's probably why I think employee ownership resonates with so many founders as a pathway.
Yeah, absolutely. So when you go, I was going to sort of go and ask a little bit more about sort of the rates and you guys, obviously in the segment that you're pursuing, it's a little bit riskier than what you're going to get from mainstream. So how do you guys think about sort of the rates that you charge? And if you could share a range, that would be awesome.
Yeah. So, we always try and, price a loan fairly. For us, it's all about providing good value. So it's
Yeah.
about, yes, as you say, there is a bit more risk in those situations when there's a transition of an ownership. And we are, we generally will price ourselves, we sort of position ourselves as being between what the sort of traditional high street banks will do
Yeah.
and what kind of the more expensive sort of private credit universe do. We are
Okay.
a regulated UK bank, so we'll sort of sit between those two extremes because we are providing more or tailored, more specialist funding, but we're trying to provide good value for that. So therefore, it's trying to look at what are the things that we think will provide the flexibility the business needs to support its growth, whether that be around managing payments of the deferred, whether
Yeah.
that's about supporting future acquisitions and growth in the business, post-employee ownership transition. From a ballpark perspective, generally speaking, our sort of pricing will have a margin against, typically against SONIA. This is how we price most of our loans.
Yeah.
Now we'll typically be in the kind of somewhere in the 5s to 6% of margin is
Okay.
what our typical range will look like.
Yeah. Okay. Very cool.
But it's trying to be framed depending on the risk profile of the business, how much looking to borrow.
I'm sure the audience is going to tie it, hold you to that. Well, you did answer sort of one of the questions I did have, like in terms of growth capital. I mean, it's the number of EO businesses in the States is growing rapidly, and the funding mechanisms they've got to be able to go and acquire these other companies into their sort of ESOP models is very mature, and it's doing that. Is that something that are you seeing more EO companies being more acquisitive and looking to be able to get some more leverage to drive that? Or is that just something you guys are looking to market as well?
Yeah, no, we do. I think it's a lot of the companies we support, it's balanced because they've got one eye on the deferred
Financial Freedom Day.
Freedom Day and looking to get that element, which we totally understand. But equally, they've got growth aspirations within their business. So it is trying to strike that balance as to the priority as to where they want to. There's limits to what financial capacity a business will have from a lending perspective, and therefore it's choosing how to deploy that sensibly. No, I think we do definitely see across the UK and a lot of our clients, there is this confidence around opportunities. There's difficult markets out there, but there's good opportunities in every market, and therefore I think the appetite for follow-on funding and providing that growth finance is something that we encourage. We're an entrepreneurial lender. We like to back entrepreneurial businesses that want to grow and invest in themselves, and we like to provide the finance to support that. I think the US example is an interesting one because the US has a lot more structural support and government support around the ecosystem than we see in the UK. Which obviously we budget day to day, so we'll see what happens from Rachel. But I think it is a slight missed opportunity in the UK that the ecosystem is not as supportive as it could be, and we do our bit to try and provide that balance. But I think there's a reason the sector is smaller in the UK than it is in some other institutions where you see more government supports for for employee-owned and other similar businesses.
Okay, you're talking specifically like in the US, like the Small Business Associate, like administration, sort of loan guarantees and the like?
Yeah, the likes of those initiatives, I think partly in our view why you see more finance support available in the US versus the UK.
Yeah. Okay. On that, like if you think about a typical M&A transaction with like an independent sponsor coming in, like to be able to help support that, a lot of the times they're offering up a personal guarantee as part of that transaction. How do you guys operate in terms of, do you require any PGs when you're providing, like how does that work in an employee-owned environment?
Yeah, so generally speaking, we will occasionally take PGs, but our standard is not to. We generally prefer to be structuring our lending and looking against the underlying business and backing the business, the employee owners, the management team, and sort of trying to strike an appropriate financing package. So it's something that on occasion we will, but it's certainly not it's not something, a lever we pull quickly. We'd rather try and structure something against the strength of the business itself and business that we back to go on that journey and provide the finance.
Okay. Does that limit sort of the amount of like turns of EBITDA of debt that you're able to provide?
I wouldn't say necessarily limited. I think we'd always, probably if there's something pushing the boundaries of where our risk appetite might be, that maybe is when we look at sort of guarantees. But generally speaking, we will look at something in the kind of range of sort of leverage, usually in the 2s is what we'd say for a neo business. So kind of mid to high 2s would be sort of our sort of general range, subject to vagaries of sectors. So we certainly will, we do think that there is, as long as there's a good underlying business, with good cash flows that we provide funding into, we think it can support a reasonable degree of leverage. But one of the things we always have to bear in mind with employee-owned businesses is they are employee-owned, and therefore, particularly majority employee-owned, you don't necessarily have a wealthy shareholder sitting behind the scenes that can support if the business hits a bump in the road. And therefore, in our experience, the employee-owned businesses themselves and us as a lender, we don't want to overload businesses because they don't necessarily have that that flexibility of being able to call upon a shareholder to support if there's challenges down the line.
Okay, so I mean, the US lenders sort of talk about like the 1.5 debt service coverage ratios. Is that, I mean, do you guys, with that in mind, without having sort of the big benevolent owner able to, do you guys look for a little bit higher than that?
No, so we definitely will. We'll look at the serviceability. So the debt service ratios is something that we will focus on. And one of the things we look for in any lending situation, particularly employee owned, is a good financial forecast from management team that we can assess the expected cash flows, the profitability of the business that's going to service the loan. And we typically our sort of covenanted ratios usually account 1.1, 1.2 times debt service cover.
You say covenanted ratios.
So the ratios that we will require the businesses to meet in order to continue.
Yes, okay.
But we pride ourselves on being sort of a bespoke lender, so it's not sort of a one size fits all.
Yeah.
It's not just we sort of apply the same metrics to every business and say, here's your size, here's the amount of loan. It's very much tailored to what is your business, what does it do, what are your aspirations for why you want to borrow the money and how much, and trying to tailor a package that we think works for us and works for the business.
Yeah. When you talk about all this customization and tailoring, for me, that sounds like a lot of time and effort, from you and also from the business. I mean, if you could just talk us through a little bit more what that process looks like.
Yeah, so it definitely does take some time. It's not something you do overnight. It's we're not a sort of a computer says yes or no sort of operator. It's very personal, and therefore I run a team across the UK that works directly with the businesses, and we'll talk to them about the strategy and the funding need. And I say it will be a conversation. So it's not something that is a task that should be undertaken lightly. Like any business going through a transition to employee ownership, you've got to think carefully about what you're looking to do and why, and therefore the financing that goes with that. I wouldn't say it's arduous. I think it's the sort of information, the sort of questions that we would be asking, business would be exactly the same things they should be thinking about for themselves anyway.
Well, they should be. I think is the key point there. Even if in a situation where it's 100% seller finance or deferred consideration, they're probably not going to be doing the same levels of due diligence that you guys are asking for. So it is a step above.
Yeah.
So how do you help people understand, like, to go through that journey? Because I guess it's also, this is the reason why some people don't go through a trade sale because of the poking and prodding that needs to happen for so long. Even though it's good to know what your bed looks like and then make sure everything's in order. But how do you help people be comfortable with that?
I think it's about having an experienced team that can have been there and done it before. It can talk the either a management team or the vendors through that process and help them understand what it'll involve, and help them understand actually it's not usually as painful as people maybe think it will be.
Yeah.
Because in my experience, people love to talk about their businesses and they understand their business better than anyone. And actually, the disciplines of that prodding and poking, if you use that phrase, is a good thing. I think you learn things about the business. Oftentimes people will find new approaches that they might want to take around how they manage business, and so actually putting some of that structure in place, getting some of the information that we want to capture on a regular basis. There's a lot of go forward benefits to particularly if you're moving away from a founder run business where the founder has been there, seen it all, has got his hands in everything or her hands in everything. Actually, if you're moving to a slightly different style of leadership, the broader group of stakeholders involved, having good information and good understanding of what's going on in the business to monitor and manage it on a go forward basis is really valuable.
Yeah.
So I might encourage people not to be afraid of that, and part of our job is to help people go on that journey and provide them with our insights and what we've seen with other businesses as to how to approach that.
Yeah. Well, it's sort of, I mean, this is part of the growing up. Really, as a business, I think you articulated that really well. Like, this is key for them to be able to better understand it moving forward in this new ownership structure.
Absolutely.
Okay. How do you guys, I mean, you said you got people around all over the country. How do you find clients?
So events like today is for us. So it's a combination. So probably about half of the clients we look at will approach us directly, either through the website or through a relationship they have, or business owner that they might know that's worked with us before, has experience of us. So quite a lot of sort of direct related. And the remainder will be often intermediated in some way. So often business going through some kind of employership transition will have some sort of advisor involved, and therefore we get a lot of referrals from the broader advisory community that are either lawyers or the accountants, corporate finance advisors, or sometimes businesses will engage a specific debt advisor that will help them search finance, and we'll refer to ourselves through that.
Okay. And like, is the majority of the time you're coming into like just reduce that amount of deferred liability. It's coming. Is that right?
Typically, yes. So
Yeah.
it's about trying to strike a balance as to, take some of that deferred down, maybe accelerate the, pathway to that, National Freedom Day. And we will deal both with initial transitions where it's part of the agreement with the exiting founder as to, how that structure is going to work. Sometimes we don't get involved directly in the discussions, but the elements of financing and the amount of deferred upfront versus upfront will impact on valuation discussions as well.
Yeah.
So sometimes that's as part of the transition, then sometimes it'll be a case of, post transition, looking at maybe accelerating some of those payments. Maybe everyone's comfortable that the business is now successfully navigated through the transition and it now wants to accelerate those payments to either to increase the percentage ownership between employee ownership and founder, or just say accelerate the deferred payments. So it'll be a mix of initial transition and already transitioned businesses looking to take out some of the vendor deferred, or it'll be a business that has made the transition looking to do growth finance in some way, so M&A, for example.
Okay, really cool. So, Chris, thank you so much for the conversation. Before we end, I like to ask people 3 quick questions.
Oh, yeah?
Are you game?
Go for it.
All right. Who is the leader that you most admire in employee ownership?
Oh, it's an excellent question. I think for me, probably the origins of it through a lot of and not once necessarily counted as employee ownership, but the cooperative movements. Going back way into history. I think I dealt with a number of not as much in my current role, but in previous employers, a lot with co-ops, and I think the origins of both the co-op movements and John Lewis and how that's kind of come through to the modern day and the inspiration that history into the Victorian era is provided to the modern day is for me what's gives me a lot of inspiration for the energy in the room that we see today.
That's fantastic. I love that one. That's a new one. So the next question is, what's your favorite resource on employee ownership?
So the Employee Ownership Association, obviously.
Okay. Well, it's good. It's not obvious, but it's good. I don't know why, but awesome. Very cool. And then finally, what would you say to a business owner who's sitting on a fence about a transition towards an EO model?
I mean, for me, I think come to events like today, talk to businesses that have gone through the transition. I think that's one of the best ways to get a sense of what it really means and what it would involve. I think it's really worth doing your homework on it. And the last few days, talking to so many businesses that have already been through that journey, they're really passionate about it, but they're also really, really open to talking about it. So talk to colleagues, talk to other businesses. And if you don't know them, things like the EOA are a really great way to get connected.
Fantastic. Awesome. Chris, thank you very much for your time. Where can people go if they want to learn more about Shawbrook and follow your story?
So Shorebrook's our website be the best place to go, or follow us on LinkedIn.
Okay, awesome. We'll have links to that in the show notes. Chris, thanks for joining us on the Alternative Exit.
Andy, thanks so much. Good to meet you.
Cheers, mate.